Welcome to the Dollar Debauchery program, brought to you by Cliff Cool's Notes, a daily consolidator on the most insightful presentations, articles, essays, and the interviews on the web on the ultimate confidence game, money. Our site presents ideas from the smartest and wisest money managers, economists, and analysts.
This is Crystal Ferdinand here for Cliff Küle. I'm here with Nomi Prins, former managing director of Goldman Sachs, and she is the author of the bestseller, It Takes a Pillage. Okay, so your most recent book, All the President's Bankers, is coming out next April. Can you tell our audience what was the motivation for you in writing this book and what are some of the main points of the book?
The book is really a sort of genealogy of the power at the core of America, particularly over the last century. I start the book after the Panic of 1907 and go through from Teddy Roosevelt's administration, before that, during that, and through towards the Obama administration, and look at the lines of family, of blood, of mentorships, of protege relationships that really drive the sort of handing over of ideology and the containment of power at the top echelons of American politics and finance.
Okay, so can you give us some examples from the book of some relationships between U.S. presidents and their key bankers over the past century and the impact it had on the U.S. domestic and foreign policy?
Well, for example, just starting at that beginning of history, Teddy Roosevelt was known as a big trust buster and all of that, but he was also part of the sort of American aristocracy, as it were, the Roosevelt family, as was the Morgan family. And when the panic came about, Teddy Roosevelt was so afraid of what could happen to the economy in America that he basically gave J.P. Morgan at the time carte blanche to buy whatever banks he needed to buy. He needed money from Morgan to basically sustain the economy. This was before the Federal Reserve existed. And anything he said against the big trust and against bankers, he did not say against Morgan. And as a result, and our country today is based on this result, the bankers can have monopolies over finance and over the economics of the country, whereas other industries have more monopoly issues and get more sort of lawsuits, etc., related to that. After Roosevelt, Woodrow Wilson, later on before World War I, he came into power as a president, denouncing bankers, denouncing the money trusts, talking about how we needed a Federal Reserve to help credit for the people. He didn't talk about it as credit for the bankers, which in fact it was, because they were involved in creating it and designing it, even under Wilson, which history tends to overlook, which I found a lot of information for the book. But when World War I came about, it was to Morgan, Jack Morgan, now the son, again, this is a family situation of J.P. Morgan, that Wilson and his administration most collaborated with to help finance the U.S. in World War I and help the U.S. catapult itself to a world superpower, which it then built upon over the century that followed. You know, we look at the last crisis, and there's a lot of points in between. Of course, we could go on and talk about all the presidents and the relationships, but even with Obama and Jamie Dimon, or with Bush and Treasury Secretary Henry Paulson from Goldman Sachs, you have this history of an ideology that says that if you don't help Wall Street, you don't help America. If you don't help support the banks, whether it's through Treasury or Federal Reserve policy, somehow everything's going to blow up, when in fact what blows up are the banks' positions and they get subsidized.
Do you think that this behavior is unique to the U.S., or are there similar relationships between government leaders and their banks?
Well, certainly there are relationships in a lot of the first world countries with their banking establishments, and there's more tenuous relationships because the banks are far less developed with some of the third world countries. But there is no country on earth that has such a tight connection between the presidency and the financial community, because they really are the same people. And that's something that developed uniquely in America. It was uniquely the same families. They uniquely yachted together and built the same clubs together and went to universities together and were friends with each other. And for decades and decades, through presidents from Teddy Roosevelt to FDR, through to Eisenhower, to Kennedy, and so forth, you see how this relationship has built upon itself and how it's really driven American power. And there is nowhere else on earth that has that same tightness.
Yeah, for sure. So, can you explain how the Federal Reserve monetary policy since the onset of the financial crisis has been benefiting the big banks and not Main Street?
The Fed has been created back 100 years ago to help the banks. That was the entire purpose, and that hasn't changed. And so in the most recent crisis, what happened was the Federal Reserve provided low interest rates, zero interest rates, quantitative easing, which meant not only could they buy bonds from the Treasury Department that went through the banks to the Fed, they could also buy mortgage-related securities, which were at the heart of the crisis. These were the things that were corrupted. These were the securities that contained the most fraud. These were the securities that were sold to municipalities and pension funds and smaller investment funds as much more credible and having much more financial integrity than they actually did. And the Fed went out and bought them off of the banks' books just to help the banks relinquish some of that rot. And so that was an example of a policy that the Fed continues to this day. They have said they are tapering what was an $85 billion per month buying program, which is now a $65 billion buying program. That's still buying a lot of bonds, and a lot of them are still coming through the banks or from the banks' books to help them alleviate their own stress and their own potential losses. Meanwhile, they have zero interest rates that they can use to amass money to speculate in any type of market activity that they want to, and this hasn't translated into zero interest rates for the rest of the population. There are no zero interest rates on student loans. There are no zero interest rates on credit cards. There are no zero interest rates on auto loans. There is no mass restructuring of the mortgages that individuals had that were corrupted at the start and into the crisis. So all of the Fed policy has really been geared to, despite language to the contrary, help the banks and the financial system, which it has, look at their stocks, and not the overall mainstream population.
Yeah. So when you say it's like it's not really creating jobs to help people, and how do you know that this was like the Federal Reserve created this as a backstop to the pitfalls of risky bets kind of going wrong?
One of the things I did for researching the book is I took a trip to Jekyll Island, which is off the coast of Georgia, and I sat down and looked at documents and worked with the archivist there and so forth to examine the first meeting that was held at Jekyll Island in 1910 by the senior senator on the sort of monetary policy creating committee in Congress, and the five bankers that accompanied him to discuss how to create a Federal Reserve. This happened since the panic of 1907. So for 3 years, there was discussion in Washington and amongst the bankers as to what to do to make sure that if panics arose, and this was after that big panic of '07, there would be help beyond the banking community so they wouldn't have to save themselves. They could rely on the government to do so. Now, it would be a bad political faux pas if any president were to say, hey, the government's going to help the banks. It's what they did in practice, but they couldn't really say it. So the Federal Reserve was a way of establishing a bank that could create currency, which was being created really by the banking system. There are lots of individual banks issuing their own forms of notes and so forth, to have it consolidated, to be able to therefore compete with European central banks who could create currency over there, and therefore manifest a stronger, as they thought of it, U.S. economy, but through the banking system, and to allow banks in future pitfalls to have a place where they could go to make sure they could get money if there were runs on banks or if anything else happened that was negative to them.
So with the Federal Reserve, its anniversary, 100th anniversary is coming up, and it always comes to rescue the banks. And if the big banks begin to implode on derivatives and meltdown, or problems come up with toxic assets, if so, like, what do you think the Federal Reserve would do? Like, what effect do you think these actions will have on the financial markets?
Well, we've already seen them come to the rescue of the last pass, let's say, of toxic assets that erupted in the crisis of late 2007 and in 2008. The Fed chose to loan the banks money at very low interest rates in return for toxic assets. When that was done, they just bought some of those old assets from the bank's books and so forth. In terms of derivatives, just by creating these abilities and these loan pools that they can find ways to give financing to the banks when they are most needing of it is a way to also create a possibility of helping them in a big derivatives meltdown. All they really have to do is funnel liquidity. It's basically the equivalent of banks floating around in some boat in the middle of the sea. The boat has a hole in it. The Fed's there to keep patching the hole, patching the hole, patching the hole. Throwing out the water buckets, throwing out the water buckets. And even though it's piecemeal kind of salvation, the Fed is very adept at finding creative ways to continue that along if there were to be a big crisis. They did it in 2008. There's no reason to assume there won't be new methods and augmented methods to help banks in a future crisis.
So, what do you think will happen to the financial markets and to the real economy if the Federal Reserve backs off on its massive monetary stimulus?
Well, I think the Fed doesn't want to know. I tweeted today that whether it's Yellen or whether it's Yoda, there's a force of the Fed for the rest of the financial community, and that's not going to be disturbed. So even though there's been a small taper, the markets, and therefore the banks behind the markets, responded to that positively because they know, A, it's a small taper, and B, even if the taper gets worse and their position is worse, that the Fed will find other ways to help them and to boost them and to finance them. And so that's really the policy that the Fed had into the crisis, and it will be the policy that the Fed has as long as it is needed. There's no countermeasure to stop that situation. The countermeasure would be to regulate the banks better or to separate their speculative activities from their depositors, and so to unchain the responsibility of helping the banks from the government, from Washington, from the Fed, but that's not happening.
So do you see the possibility of any bail-ins with banks globally upon the next banking crisis?
There is a serious possibility because even if we look at the U.S. and look at the FDIC, which was created in response to the crash in 1929 and in conjunction with the Glass-Steagall Act, which separated the deposits of banks from their speculative and asset creation capabilities, that doesn't have enough capacity. It doesn't have enough money. It doesn't have enough insurance premiums that the banks are supposed to provide it in order to really, really be there in the event of a massive crisis. And so, although, again, that would be a situation where the Fed exhausts its tools or needs help or whatever the situation may be, the FDIC, which is in the position of insuring deposits, just really doesn't have enough insurance money in the event of a major catastrophe to not consider going after some of those deposits or to just be unable to continue to insure all of those deposits. And that's where you start to look at possibilities of types of bail-ins.
So are banks now more too big to fail than before the financial crisis? Do you think that?
Banks are absolutely bigger and more likely to fail after the crisis than they were beforehand. Why? Because they've grown in actual size of assets. JP Morgan Chase, for example, was able to accumulate Washington Mutual as well as Bear Stearns. Goldman Sachs was able to, and Morgan Stanley were able to recreate themselves as bank holding companies, which means they have tiny bits of deposits, but they have lots of federal support behind them and so forth. So you have the biggest six banks in control of more assets, and also none of them have been beaten down in terms of their speculative activity. So rather than being separated from having investment or asset creation capabilities from their regular mainstream deposit and loan activities, they've been allowed to grow both of those areas at the same time with really nothing meaningful. I mean, there's been the Volcker rule that's still in debate and all sorts of things that are discussed as potentially being meaningful towards reducing their risk, but they have so many loopholes in them. And I mean, I've gone through the rules that are as they are right now, and there's many, many, many pages of exemptions relative to tiny little amounts of rule anyway, that they're really not helpful in reducing the risk. So yes, you have bigger, more consolidated banks, and they therefore are more interconnected and have the capacity to instill the risk that they have onto the rest of the world in a much more heinous way, should there be another crisis. And there will be another crisis because nothing has changed.
Well, thank you so much for doing this with us. And this was once again Nomi Prins, and her book is coming out in April, All the President's Bankers. So thank you.